Let's get to today's market movers with easy to follow futures and options trades from CME Group.
Welcome to Market Movers. I'm Jim Uriel, and we are a week away from the September jobs report. We're looking at using E-mini S&P weekly options to either hedge risk or create additional exposure going into this event. Joining me is Chief Market Strategist for Path Trading Partners, Bob Icino.
Good to be here, Jim.
Glad to have you. So the jobs numbers, the labor market in general has been the brightest spot of this recovery. Do you agree with that? And do you think it'll continue?
I do agree with that, and I do think in the short term it continues. Jobs are a lagging indicator. Wages sometimes lag a little bit behind that, which we saw in the last number. So I think it is going to continue. We have to look at it juxtaposed with what the Fed just said, because that's now the backdrop.
Okay, so is good number good for the stock market, or is good number mean the Fed gets more aggressive?
You know, given the tariffs and the trade war, I think good numbers have to be good, because that's the cover for the trade war.
No, I agree with you.
Is the good economy.
I agree with you completely. Now, before we dive into the trade discussion, I'd like to point out, with all market movers, it's important to view these as examples that allow you to see different ways to use futures and options products to manage risk or create additional opportunities, not as recommendations or advice. Price and movements will vary in this. When we price these, the underlying, the DEES contract in the E-mini S&P was $29.25. Bob, you're up.
So I am bullish, and we are owners of equity. So I want to use the CME products. You know, I cut my teeth here at the CME. So I use this stuff to protect the investments that I'm already in. So I want to buy a put spread here. I want to buy a 29.10, 28.85 put spread. I can do it for about 5 ticks right now, given where the underlying is. So this is insurance for me.
I like this. So this is a traditional hedge. It goes off the day of unemployment, several hours after unemployment. It protects a bullish thesis. It risks $250 to make a potential $1,000. But if you don't make it, you don't make it.
No, exactly. I mean, if I don't make it, I'm happy. If I make it, I'm happy. That's exactly what these products were designed for.
I actually like quite a bit. I also have had a bullish thesis for the last few months. I think things are good right now, and I see nothing that turns it around. So I'm looking at buying the week 2 October 29.40, 29.65 call spread for 8.5 ticks. It expires October 12th, a week later. It risks $425 to make $825. So I'm paying up more for this, but this isn't just insurance money. I'm hoping that this fills out and makes money to satisfy my bullish thesis. And I got one more week, so it doesn't zap all the vol out of it right after unemployment. Thoughts?
You know, I like this. Obviously, I'm bullish, so I can't not like this. It's a cheap way to get long rather than expending all that money for actual equities. I like this a lot. I think you're going to make
volatility. If the VIX was a lot higher and volatility was more expensive, would you look for ways of selling options to take advantage of that? Is both of us are paying money? Is that because of where the VIX is, in your opinion?
I think so. I mean, when you look at it, this essentially means a longer-term trend is still in place. It's going to take a lot of news to derail that.
I like it. Thanks for joining us on Market Movers. I'm Jim Uriel, where we're hoping to make you a better trader.
Check out businessfirstam.com to find out where to see our entire show. And don't forget to like, follow, and share Business First AM.